Ossoff virtually from his office.
Thank you, Madam Chair, and congratulations to the nominees. Thank you for joining us. Mr. Barr, have you given any consideration to, and what is your assessment of the distributional effects of monetary policy decisions?
Thank you, Senator Ossoff, for that question. I think that the Federal Reserve's tools with respect to monetary policy are pretty simple ones, and they operate in pretty simple ways broadly in the economy. So when the Federal Reserve is getting its job done right, the economy is working well for everyone. And that is especially true if you're a low and moderate income worker who might be late to the job market. If the Federal Reserve is able to, with price stability, maintain lower rates, then that is helpful to you. And conversely, if the Federal Reserve is not able to do that and unemployment is too high, or if inflation gets too high and inflation begins to erode wage gains as it's doing today, then that is also harmful to working Americans.
What's the impact on asset valuations of a dovish stance by the Fed?
Well, in general, when interest rates are quite low, asset prices tend to rise. And when asset prices tend to rise, those who have more assets have a greater ability to take advantage of that opportunity. And conversely, when interest rates tend to rise, asset prices tend to be more muted. But the overall point is that with respect to monetary policy, if the Federal Reserve is getting its job done right, the economy is working for everybody. And I think that's the main goal of monetary policy.
Why, since 2007, 2008, has the posture of not just the Fed, but many central banks necessarily been low rates and a lot of extraordinary bond buying that were not previously normal policy tools? Why has that? Why have monetary policy makers, in your opinion, taken that posture or felt they need to take that posture in OECD economies, Western economies, since the recession of 07, 08?
Thank you, Senator, for that question. In general, when rates have been low and central banks have been pursuing asset purchases, it is generally speaking for two main reasons. One is to mitigate against financial stability risks facing the economy at that time. And the second is to effectuate an accommodative monetary policy.
Right. I guess my question is, why, in your opinion, has it been necessary in the judgment of central bankers for the last 15 or 20 years to maintain such an accommodative monetary policy? Or to put it another way, what has changed about the structure of the U.S. and the world economy such that in order to achieve its dual mandate, the Fed has deemed it necessary to sustain lower rates than the historical norm and more sustained bond buying than the historical norm, which, as we just discussed, has one of the impacts of that has been to pump up asset valuations, which has distributional effects that we've discussed. Why has that needed to be or been the posture for the last 15 years? What's changed?
Thank you, Senator Ossoff. In general, there have been a couple periods where interest rates were rising, but in general, when rates were low during those periods and when bond buying was important, it was because either of financial stability concerns facing the economies at those times, or because of the need for monetary policy accommodation given the weakness of the economies.
Yeah, Mr. Barr, and forgive me, I'm not in the room, so I don't mean to interrupt you in a rude way, but my question is, what has changed structurally about our economy such that in order to maintain financial stability and in order to sustain what central bankers deem to be adequate aggregate demand, it has been necessary for rates to be aberrantly low and for bond buying to be aberrantly high? Why has that been necessary in the last 15 or 20 years where it wasn't before? What change in the structure of our economy does that suggest or represent?
Thank you, Senator, and sorry for not understanding the nature of your question before, but there's significant debate in the academic literature about the answer to your question. Some of it has to do with changing demographics in advanced industrial economies. Some of it has to do likely with perceived overall lower extent of potential investment returns. Some of it has to do with a very high savings rate in most, but not all, of the advanced industrial economies. And people believe, academics believe, that those factors and others may have, for a long period of time, muted effectively what the neutral interest rate is. So that's a long answer.
Madam Chair, could I have the indulgence of one more minute?
Without objection.
Thank you. Please proceed, Mr. Barr, concluding the answer to that question, and then just, if you would, answer the following question. How would you or should you on the Open Market Committee consider the market effects, the impact on asset valuations of your decisions? And I think the answer can't be not at all, because it is at least a mechanism of action for monetary policy. But to what extent should the Fed consider whether, for example, violating forward guidance will have effects on volatility? Should that be part of your decision-making calculus? How will it be? So again, in sum, please finish the analysis, which I found very interesting, and I think the committee needs to hear, on why rates have had to be low and bond buying has needed to be so aggressive. And then talk to me about how you'll think about the markets when you make your decisions. That'll be my final question.
Thank you, Senator. Very briefly, I think, again, the tools of monetary policy are relatively simple, and they affect the economy primarily through the Federal Reserve's targeting of the federal funds rate, and secondarily through adjustments to the balance sheet of the Federal Reserve, and in a third way through expression of forward guidance. And the primary goal of all these efforts is to bring inflation down to the target level of 2%. Again, it's, I think, a pretty simple a goal. It's hard to achieve, but being clear about that objective, I think, is quite important.
Thank you, Senator Ossoff. I now recognize